Hello, I'm Mike Thomas, one of the board members of the Ontario Horticultural Trades Foundation. I want to talk to you a bit about a way you can increase your donations to a charity or organization of your choice like the foundation. We often think of giving in terms of cash today, but like you and how you've been successful, we do long-term planning at the foundation. Two of the long-term planning tools that will help us, and I think help you achieve the goals that you want to achieve as a donor, are life insurance and annuities. You can make sizable legacy donations to the charity of your choice, in our case, a foundation. First, I want to talk to you about the different ways you can benefit the foundation and minimize your tax burden through the use of life insurance. If you own a life insurance policy now, and you want to leave something to the foundation in the future, if it's more important for you to have the tax advantages for your estate at your death, then maintain ownership, name the foundation as beneficiary. At death, the full death benefit will be tax receivable by the charity to the estate. If it's more important for you to have the tax advantages now, change ownership to the foundation and the beneficiary. At that point, you will receive a charitable receipt for the value of the policy, the cash value, and future premiums that you pay will receive a charitable tax receipt every year. If you want, you can purchase a new life insurance policy, and the same rules apply in terms of the tax advantages. It's important that you know the beneficiary designation can be revocable, which means in the future, if you want to name other beneficiaries in addition to the foundation to participate in the life insurance death benefit, you can do that. If you want to change beneficiaries at some point, that's also allowed. Let me give you an example of how the charitable giving of life insurance can be beneficial not only to the foundation, but to your estate, a win-win. You probably have an RRIF, Registered Retirement Income Fund. It's paying you a monthly income. You and your spouse right now, possibly. You may not know, but at the death of the final spouse, the full amount left in your RIF is taxable in your final return. At the same time, your charitable life insurance has created a death benefit that allows the foundation to give your estate a charitable tax receipt, the amount of which can be used to offset the tax owing in your RIF. Here's another win-win idea. Do you have a capital gains tax situation that's going to cause a tax burden to you sooner or later, or your estate? Charitable life insurance with the foundation can help offset that tax totally and leave your estate in a better position than they currently would be with a capital gain asset. So now you may be thinking, life insurance doesn't work for me as a way of participating with the foundation. Let me give you another idea. Do you have investments that currently produce interest or dividend income for you? Well, we can rearrange those to make another win-win situation for the foundation and yourself. You take existing assets, move them over to the foundation into a charitable annuity, continue to get the income that now becomes nearly fully tax-free, plus a tax receipt for part of the asset that you've transferred over. At your death, the foundation receives the amount of money that hasn't been paid out to you at that point in time. I've talked to you about two ideas, using life insurance and annuities. And the tax advantages of these plans improve your estate situation for your family and benefit the industry that you've grown up in and loved. Both of these ideas are easy to do, and they're a win-win situation. Contact us at the foundation and we'll help make it happen.